He who has the gold makes the rules. Now, when I started in the business, I started in the business in 1971. I thought that was an old saying from the Middle Ages. Actually, I found out many years later that it's not true. That is, that comes from some kind of a play or a movie or a strip, a comic strip. Uh, and But it's actually very true. He who has the gold makes the rules. Is because, in a way, gold is real money. It's money that cannot be cheapened, cannot be devalued, cannot be made into what we know what happens with paper money, right? So now this is a little bit of a story about it. We can talk about gold for hours. I'm just going to try to make it short because the title is "He who has the gold makes the rules," but the real title is gold coming back to the international monetary system? That's the question, and the short answer is no. The short answer is no, but the second part of the answer is not yet. Likely, not yet. Likely to happen, maybe, but it may happen, and that's why it's important for you to know. Um, so I don't know if you've seen or heard or read in the papers that recently gold became the second largest component of international currency reserves after the US dollar and ahead of euros. Now I'm going to explain to you what international currency reserves are for those who don't know. International currency reserves are pools of money denominated in foreign currency that normally belong either to the central bank or to the treasury, right? In the US, they belong to treasury, but they're always managed by the central bank. Every central bank in the world manages its international currency reserves, even though they may be owned by treasury. So it's government money, and it's government money there, and it's been there for time immemorial almost. I mean, from the time that we started using money practically in the 1800s. Uh, and and I'll talk a little bit more about that. But first, I want you to know that by 2024, by last year, the value of gold and international reserves was 56% um, of the dollar reserves. 56% of dollar reserves. Most of the reserves, of international currency reserves of the world, are held in dollars. But combination of adding to gold and the price of gold going up made gold represent 56% from practically no more than about 15% many years ago. Okay. And now I need to explain to you what are international currency reserves, what are they for, what's their purpose. So, to make a very long story short, the Western world was on what's called a gold standard through most of the 19th century. And very briefly, it meant that countries settled their balances. A country imported more than it exported, so it needed to settle the difference with the country that had a surplus. And so they used to settle their liabilities in gold. But this is parallel to the fact that people transacted domestically in gold too. So gold was money. Gold was money. People transacted domestically, and countries transacted and used gold to settle their surpluses and liabilities. Into the 20th century, we began to make changes to the gold standard. We added the dollar, and what happened was because of convenience, it was very difficult to actually move around gold um, each time you wanted to settle a balance. It was the same thing is true in domestic activity. It was difficult to walk around with bags of gold. So we began to adopt what's called a gold exchange standard. And the gold exchange standard was basically guaranteed by the US. And the US said, look, guys, you don't have to own gold. You can own US dollars. And anytime you give us $20, we will give you 1 ounce of gold. For every $20, we will give you 1 ounce of gold. And so countries began to transact that way, and same thing was true domestically. Domestically, there was a little bit of a different rule, but the point is, the dollar entered the picture because it was easier to do it, and because people trusted. And this is a big word. People trusted, had confidence that the U.S. government would honor its obligations. So dollars could be exchanged into gold freely. Then came the Great Depression, and by 1933-34, the U.S. found itself in a situation where they had to devalue the dollar, and they devalued the dollar, and that represented a change in the price of gold. And they said, no more gold at $20 an ounce. You will now start paying $35 an ounce. This is what you will pay now if you want gold. I'm not going to go into the details of the pressures that led to this or anything of that sort, but just accept the fact that that was the new gold exchange standard based on $35 an ounce. All this time, currencies traded between each other, meaning European currencies, the Japanese yen, the US dollar, traded at fixed rates of exchange. Every currency had a fixed rate of exchange against another one. And in order to maintain that fixed rate of exchange, you needed reserves. For example, if the Canadian dollar for some reason would fall in the market against the US dollar because there was a large demand for US dollars in Canada to import material. And so there was a large demand for US dollars, so therefore people would sell Canadian and buy US, and there was pressure on the exchange rate. What the central bank would do is, using its international currency reserves, it would actually help to try to bring back the price into the equilibrium, into the fixed rate. So they would be selling US, buying Canadian. They would do the exact opposite of what people were doing. And so they brought back the currency back into the fixed rate, right? So prior to the bank's intervention, the Canadian dollar was weakening against the US dollar. The authorities would not allow it to weaken more than very small percentage. And as soon as it hit that percentage, the central bank would use its international currencies and would sell dollars, buy US, buy Canadian, and restore the equilibrium. So you can see that in a fixed regime, fixed exchange rate regime, you need international currencies. You need international reserves. Every country needs international reserves. They had to defend their exchange rates, they had to defend their parities, and they did that by using their reserves. At the same time, their reserves were made up. Some of the reserves were made up with gold because that was part of the old system. So they had gold and dollars, right? So almost every country in the world had, I'm talking major countries in the world, had international currency reserves made up of gold, made up of dollars primarily, and some gold. This went on for a while. And because of inflation and the war and war inflation and more inflation after that, the price of gold at $35 became very cheap. Gold became very cheap at $35. Everything had gone up by fivefold, tenfold, 15-fold, but the price of gold remained at 35. And the U.S. was committed, as I said before, to give anybody, any country in the world that came with dollars, and it would come to the U.S. government, it would say to the treasury and say, here's $35, give me an ounce of gold. The U.S. was committed to do that because it was at the center of that system, right? But the price of gold was becoming very cheap. And by the late 60s, there was an enormous demand for gold from European countries, primarily France. a tremendous demand for gold because they realized that they were being loaded up with dollars. The U.S. was running a large balance of payment deficit, very large, and they were filling their reserves with a lot of dollars. They were not very comfortable with that, and so they came to the Treasury and they said, "Please, here's $35. Give me an ounce." But of course, they didn't do it for 1 ounce. They say, "Here's $35 million, and give us a million ounces." And so they came to the US Treasury from 1968 on, and the dollar and the gold, which was $35 an ounce, began to trade slightly above 35, slightly above 35, maybe $35.25 or $35.30. At which point the US Treasury would go and sell gold in order to bring the gold back to 35. Remember, everything was fixed. There was a fixed rate of exchange between countries, and so there was a fixed rate of exchange between gold and the dollar. And so the US had to go and sell gold. The Treasury was not happy. The Treasury was not happy with having to sell so much gold. And in 1971, Nixon, in August of 1971, Nixon shut the gold window completely. And at that point, the US was no longer redeeming its dollar liabilities into gold. That was the end of it. You could come to the window was closed. Now you can see that that's a default, right? That's what's called default. That's reneging on an agreement, reneging on an international agreement that lasted many, many years, that was at the center of the monetary system. And so France and Spain and Germany and all the countries that were loaded up with a lot of dollars suddenly couldn't get the gold that they wanted to get. It's at that point that the entire system of fixed rates of exchange began to change. It was no longer, it became by custom practically, but it became so that countries began to trade, allow the currency to trade freely. So you didn't need to intervene in the market. You didn't need to keep the Canadian dollar fixed to the US dollar at a certain rate. You didn't need to keep the pound fixed to the US dollar at a certain rate. You allowed it to float because everything was already floating. Because gold was floating, everything else was floating. So the currencies were floating. Now, if you think about it logically, you don't have to be an economist to know. If you think about it logically, you realize that if currencies are floating, then there is no need for international currency reserves. What's the need for it? Why do you need it, right? And so we began to develop some kind of a doctrine or an accepted theory that says, well, countries still need international currency reserves for the following reason. And now we're going to distinguish between developed countries and undeveloped countries. The undeveloped countries, who sometimes borrowed money in the international market in US dollars, sometimes ran into financial problems. They needed dollars to pay back some interest, to pay interest or to pay principal and to creditors. They didn't have it, so they needed some currency reserves to be able to do that, to maintain their credit standing. So the undeveloped countries could use reserves to ease sometimes their financial problem. Or let's say a country imported a great deal of products from abroad and didn't export very much because their exports were very expensive and they were not able to export. And now suddenly they have a deficit, a large deficit. They need to cover the deficit. The deficit is usually in US dollars because all of global trade is in US dollars. How do they cover the deficit? Again, international reserves. The central bank will go and sell some of those dollars to importers who will be able to have the dollars to buy imports. So less developed countries had some reason to actually hold international currency reserves. Some reason, right? They were more vulnerable. Developed countries, on the other hand, had very few reasons and maybe almost no reason to have international currency reserves. It so happens sometimes that a currency will come under heavy pressure, let's say the yen or the Canadian dollar or whatever, it comes under a lot of pressure, in the foreign exchange markets because of an imbalance in trade, and then speculative money begins to amplify this 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 attack. And so sometimes central banks will decide to resort to international currency reserves to maintain or support, at least psychologically, the currency for a little while. It shouldn't fall apart very rapidly. They want to smooth the pattern. So they will go and take some of the dollars and sell those dollars in the international market in order to smooth the progress of that decline, right? In order to smooth it. But generally speaking, with the advent of floating exchange rates, you practically did not need much in the way of international reserves. And I think that should be understood well. International currency reserves became more of a relic, and now as a good free market advocate, it was a way for the government to keep money for itself, for the state to keep money for itself, right? Because they could have given that money back in some way to its citizens, but they decided to keep it, right? It's always good for the government to have money. They like to have money. Okay, so it's a funny thing because on one hand they're borrowing money to spend, on the other hand they have some money here in reserves, but they kept that money. And so what happened was that, and as I said before, they needed less reserves in general, and more than anything, think about this: more than anything, they needed gold even less. Because international currency reserves are useful in the form of dollars because you can intervene in the market. You can smooth the course, right, of your currency. You can smooth the activity in the market by intervening. But you cannot intervene with gold because gold, you'd have to first sell the gold, get dollars for the gold, and then intervene in the market. So logic would dictate that you don't need gold. Now, this is very interesting because we're now starting to move into an area that's more rational. 1980, we had a tremendous inflation during the 70s, a global inflation in the 70s. People did not trust the dollar, and so and the price of gold rose a great deal. So from $35 an ounce after they shut the window, it rose all the way to $850 an ounce almost 10 years later. From $35, it went up to $850, 10 years later. And then the US adopted a very strong anti-inflationary policy. The interest rates went up a great deal, and inflation began to recede. As inflation began to recede, some countries began to realize that why do we own any gold? We shouldn't own any gold. We should just hold and keep the dollars that we have, but we don't need gold, right? We can't, as I said before, gold is not the best way to intervene in the market. And so, Hanania, maybe you show that chart, that last chart, the one that shows the price of gold, the last one, the price of gold, there. You can see the chart that from the high of 800 and some dollars in 1980, 81, the price of gold began to recede. Inflation receded. The U.S. central bank brought inflation under control, and the price of gold started coming down. But one of the reasons it came down in the 80s and the 90s was because rational central banks began to sell their gold. Right? They didn't need it, so they began to sell it. So their selling compounded the general decline of commodity prices and brought the price of gold down to, I think you can see there, about $260 an ounce. From $850 in 1981 all the way to $260 in end of the 90s. I'll give you a very interesting example. Canada. Canada was probably the most rational of all the central banks. They came to the conclusion that they don't need any gold, any. And so Canada sold its entire stock of gold through the 90s, and they have no gold. They left with no gold, and they stayed with no gold. All they did is hold their dollar reserves. Even today, Canada has $120 billion of reserves. Over $90 billion of those reserves are in dollars, and the rest are in foreign currency. None of it is in gold, zero. But other countries surprisingly did the same. The UK sold, I believe, half of its gold holdings. Switzerland sold probably a quarter. I don't remember exact the numbers, but probably a quarter of his gold reserves. All of it because it wasn't needed. There was no need for it. There was no use for it, right? So now I come back to, maybe it's getting a little late. I'm not sure how much time I have, but now I come back to the conclusion that we have of this picture is that gold began to disappear from the international monetary system as countries uh, um, regained control over inflation, which they did in the early 80s. Um, there was, and as currencies continued to float, and as traders, speculators, users began to get used to the idea that currencies float, and they brought that into their plans. And for example, merchandisers would hedge their currency. Speculators would come in and out of those currencies, trying to make some money out of it. The point is, floating currencies became the international monetary system, and you don't even need reserves to begin with. As I said before, less developed countries use some of it, need some of it, and the developed countries from time to time would intervene in the market, but very shortly and for relatively small amounts of money. So it was not needed. So the conclusion is gold, after a long period of being at the center of the monetary system, together married to a fixed rate of exchange system, gold began to go out of the system. And so central banks sold a lot of their gold, and price got down very low to $260. By the way, I'll tell you this interesting thing. Towards the end, you can see the acceleration of prices going down from about 1996 or so. And I think the central banks realized that their selling was causing a collapse in prices. And they were not happy about that because they still had a lot of gold. So they got together, and it was called, I think, the Washington Agreement. They got together towards the end of the 90s, and they agreed, I think it was the largest, probably the largest 10 countries in the world, the largest holders of gold. They agreed that they will not sell in a disorderly fashion, that they will only sell a certain quantity every year, a grand total of 400 tons a year or 500 tons a year. And people would take a number in the queue, right? So a bank, the Belgian bank, wanted to sell, so they were the first in the queue. They then Netherlands wanted to sell, they were the second in the queue, and up to 500 tons could be sold. Anybody wanted to sell more gold after that had to wait for the following year. So this orderly disposition, this brought an orderly disposition to the market. Market recovered. You can see a very fast recovery to $320 after that. And that was the bottom of the gold market in the late 90s. That was the actual bottom of the market post 1970. So now we come to the story of the years 2000. And I'm going to show you a few charts. Let's see, Hananel, maybe. Yeah, so first let's look at this chart. Let's look at this chart. This chart we should have seen right in the beginning, but this chart shows, by the way, the brown line is the value of gold at market prices held by banks, by central banks in their international currency reserves. You can see that. You can see the value of dollars held by central banks in the blue line on the top, right? The blue line on the top. And you can see sort of now it's stabilizing. It's been stabilizing for the last 4 years. And then the middle line, the green line, is the proportion of gold at market values to dollars. And as I mentioned to you in the beginning of our talk, it's about 56% now. You can see how that proportion has been going up. All right. So now let's go on to the next chart. And then I'll just bring one chart and we'll here is the amount of dollars, the share of US dollars in foreign exchange reserves, right? You can see it's coming down from 72% in the late 90s to something like 54, 55% today. Less central banks hold less dollars in reserves. They don't necessarily trust dollars so much. The next chart. That's quarterly net purchases of gold by central banks. What happened is, starting sometime in the early 2000s, for the first 4 years, central banks were selling that gold. They were still selling gold at about 500 tons a year. Sometime 3 or 4 years later, you begin to see that they're not taking up their full quota. They're only selling maybe 400 tons. Maybe a year later, they only sold 300 tons. And maybe a couple of years later, they stopped selling. And then you ask the question, but why did they stop selling? What is it? Should they not have continued selling? And here comes now a more philosophical issue. I believe that what happened is that governments themselves began to realize that money was being depreciated around the world. Central banks were creating a great amount of dollars, a great amount of currencies. All over the world, they were creating lots of euros, lots of dollars, lots of yen. And they realized that the value of these currencies would depreciate in real terms over time. And so even holding money market instruments, so bonds, would perhaps not be sufficient to maintain or preserve the purchasing power of their reserves. They were very interested in maintaining the real value of their reserves. And so you see how they went to a positive number. They started buying gold. From selling gold, they went to not selling gold to buying gold. And that was in the years 11, 12, during the Great Recession, and they bought some gold. It did very temporarily for 1 quarter during the pandemic. Some of the countries needed to sell some gold in order to raise money because of the crisis. And after that, it shut up. So 2021, with the inflation that we had in 2020, 2021, 2022, central banks became more active and started buying more gold. And you can see that on a quarterly basis, they've been buying somewhere between 200 and 450 tons a quarter of gold. It's a fairly large amount. So it does tell you that central banks themselves, and they're not speculators, they're very conservative people. They're bankers. They're very, very conservative, but they no longer trust. And for example, they won't trust the U.S. government practically. They were buying most of their holdings in dollars were held in U.S. Treasury bonds, and yet they rather have gold than U.S. Treasury bonds. You can see that, especially so because in the last few years, the U.S. has run enormous deficits, and it's unlikely that the U.S. government will ever be able to pay back this debt. At least not in the same dollar or purchasing power that it was when they borrowed it. Of course, they'll always be able to print money and pay back, but when they print money, they will devalue the value of the dollar. And so when the creditors get their payments back, it won't be the same. And this consciousness has begun to filter through, even to such conservative bankers as central bankers. And so now they've been big buyers of that gold. Let's see, there's any other here is a chart that we saw before, so maybe we don't need to see it, but you can see the blue line is right the amount of gold as reserves in central bank holdings. Okay, but let's continue. Next chart. That price, we saw that. And is there any other chart? I think that's it. We've done it, right? So now,
Those are all
I
the charts, Dov.
okay, very good. So what we have here is, in conclusion, we have a movement, what looks like a movement towards bringing gold back into the monetary system. And the reason we call it that way is because it's going into international currency reserves. And that makes it part of the international monetary system. But really, if you think about it, really, it doesn't really belong there. It doesn't belong there because we don't need currency reserves, as I explained before. There's very little need of it. So what is happening? Well, what is happening is governments like to accumulate resources, and gold is a very strategic resource, right? In times like today, where there's a fragmentation in the world, a political fragmentation, when, for example, governments expropriated, let's say, Russian assets at the onset of the Ukrainian war. They took $300 billion of Russian assets and they expropriated it, right? Where it's possible for a government, just like it's possible for a government to raise unilaterally tariffs, the US is doing that. It is also possible to contemplate the idea that the US government would one day say to China, look, you have $2 trillion of our bonds, we're not going to pay you, or we're not going to pay interest on them, right? So we have gone into a new world, a world that anything can happen. Anything can happen, right? There are no rules. There are no more rules. The old, steady, disciplined world of last century or early in the 20th century is gone. It's gone. And so now if it's gone, the question is, you have to look out for yourself. You have to own some strategic assets. And so countries may, for example, many countries say dollar balances, they're in bonds. They're afraid of being expropriated, or they're afraid of those bonds losing value, or they had deposits. Canada had about, I don't know, $10 billion of the dollars that they have in euro deposits. Well, those deposits can be expropriated. It's possible. So for safety, gold is strategic. Nobody can depreciate the price of gold, right? You own gold, nobody can depreciate it. The only way gold increases in supply is by production, and there's very small increases of production a year, maybe 2% a year of production increases, maybe less. And so gold is a very desirable asset to own in case something happens. You need to make payments, you need to buy arms, you need to buy food, whatever needs to be done. And the thing is, it should not be underestimated, because this is not a decision of only one central bank. This is a decision by many of them. I believe there's over 50 central banks that have decided to increase their gold reserves, right? So it cannot be underestimated. But for now, it is just a strategic asset for now. I just want to conclude by speaking in terms of what could happen. It's unlikely, but what could happen. What can make gold actually come back into the monetary system? And what can make it come back is if the market prices gold at a level that is more significant in terms of money circulating. Between 1971 and today, the value of gold held by the United States government, I'm only using the US, which is the largest holder, but I didn't use all the gold around the world, and nor did I use all the currency around the world. I just compared US held gold to US money. The ratio of US gold to US money, gold at market value, went from it fluctuated between 2% and 4%. Between 2% and 4%. You can see it's pretty insignificant, right? Between 2% and 4%. To give you an idea of significance, during the gold exchange standard in the 30s, 20s, 30s, the U.S. held gold was between 35 and 40% of the value of money, right? Between 35 and 40% of value of money. And it had to be so because, as I said before, you could actually exchange dollar balances for gold. So you couldn't have too many dollars around, otherwise you wouldn't be able to exchange it. Nobody would sell it to you. So 35 to 40%. Now it's 2 to 4%. So for gold to become really significant as a monetary asset, to come back into the monetary system, it would have to rise somewhere between 5 and 10 times the price of today. I can't tell you whether it will or it won't. We have seen a lot of different things. We've seen a lot of things. But one thing is pretty clear is that, at least for now, it is a strategic asset, and central banks are desirous to own this. And by the way, most of the buying of gold in the last 3 years and most of the rise is probably associated with central bank buying, not speculators. It's very surprising, but it's not speculators. We can tell that by looking at the various compositions of speculators' positions. There's been very, very small increase, very small, maybe in fact not even an increase in speculative positions over the past 3 years that we can see. ETFs, gold ETFs have not risen a great deal. In fact, have come down for the past few years. The units. Open interest in the futures exchanges has not risen. It's lower than it was many years ago. So, but I would say that most of the buying is done by central banks. And very soon you will see the public begin to join in the buying. And if they do, we may see a much greater rise in the price. But it will take quite a bit to be able to get gold back into the monetary system. And to get it back into the monetary system means that at some point in the future, gold once again becomes money, whether it's exchanged against something else, but gold becomes a center of the monetary system, a money that people can trust, and not paper money that today central banks themselves are not trusting. That's the end of my talk. If you have any questions, I'd be happy to answer.
I guess I would say it this way. It's to me that what's happening now is really in many ways a replay of what was happening in the late 60s, early 70s before Nixon detached from gold. And I would like to formulate this maybe in a little bit in a philosophic way. You know, there's a joke of sorts that it says that neurotics build castles in the sky and psychotics move into them. That is, the problem with human reality is losing touch that there's something called what we call in Hebrew mitziut, reality, and the dynamics of politics is to detach from it. And the more societies become politicized, the more they become detached that there is some core fundamental reality. And I would suggest that now we hear a lot of threats from China. You know, they want to move the international the Chinese currency to become the new international reserve. Why? You know, what it is that they want. And my proposition is this: what's happening in the world today, it is becoming increasingly politicized. There's just no place that's attached to reality. The United States is becoming detached. Who in the world would trust the Chinese currency as the most politicized governments in the world? Who in the world would trust them? So if this is dynamic, I think it makes a strong case for what you're implying here. Really, the only reliable thing is to get away from all this and reintroduce reality into global consciousness, which is basically gold.
I would agree with you. I don't think it's a question. I would agree with you. That's probably the case. That governments today practically they ignore the fact that we are getting into an unsustainable situation by borrowing and not thinking of repaying. There is no way these things can be repaid today without inflating the currency, just giving you back half or a third or a quarter or a tenth of what they lent.
My name is Dafna Meir, and I'm one of the students here. I wanted to ask, they recently found a huge amount of gold in Uganda. How have it affected the gold prices? Because since there is a lot more of the limited resource, it may affect the gold prices.
Yeah, I'm going to repeat your question. You say that they found a great amount of gold in Uganda, right?
Yes,
And you want to know how that would affect the price.
How did it affect the gold market?
Right. Okay. It's good. I didn't see that. I haven't seen it, but the main problem is usually the cost of extracting it, right? We could probably find gold in Mars and under the sea. There's probably a lot of gold under the sea, but that doesn't mean that the price of extraction is economic. It could cost $1,000 an ounce. It could cost $2,000 an ounce. Some of the best mines in the United States and in the world extract gold today at somewhere between $1,000 and $2,000 an ounce. They're making money, but it could cost $100,000 an ounce or $50,000 an ounce. So it's not the question. The issue is not gold. The issue is the cost of extraction. What does it cost to bring it out? And Uganda is not a very safe country, probably, and it's unlikely that they would be able to raise the amount of capital that they need to get it out of the ground, and the transportation issues, and I don't know how deep it is. The South Africans have gold mines that go down kilometers underground, right? So it's very expensive to get it out of the ground.
So you don't think it's going to affect too much the current market?
I don't think so.
Okay.
I don't
Thank you
think
so
so.
much.
Hello, my name is Ishai.
Yeah.
Hello, my name is Ishai Zemgen, and I'm a medical student.
Yes.
I wanted to ask you about gold. It is true that it's finite, and it has a restricted amount, but still, with some kind of a big technological breakthrough in fusion and space travel, perhaps the asteroid and so on, isn't feasible that the value of gold, like the bet Julian Seaman did with the other Professor Ehrlich, that the price of gold, which is a finite metal like tin, will suddenly drop. And so why not invest in things that are maybe more secure, like Bitcoin, that its software is defined in a way that will not cause huge inflation in accordance to progresses in technology and so on?
What you're asking is a good question, and we've seen that happen in diamonds, for example, where diamonds have been made laboratory diamonds, right? And we're able to make much cheaper diamonds than the ones mined using a similar or the same process, just with technology. But as far as I haven't seen anybody coming up with a way to making lab gold, and we have a history of it, right? We have 5,000 years of history where the supply of gold has been very small, very, very small. So we have a history that says the supply is small and acceptance is very high. And don't forget, one of the assets that gold has is that it has a use, like Bitcoin, for example, or any other of these cryptocurrencies. Gold has a real use. Women like it for jewelry. Industry needs it. There's a lot of uses of gold itself. So it has become the favorite way of holding it. I'm not saying that it won't happen that countries will adopt some cryptocurrency if they felt safe, if they felt that that they cannot be hacked or anything like that. It could be, but for now, what we have is history, and history has shown that there's a huge preference for gold.
My name is George Lichtenstein. Can you hear me?
Yeah,
Okay. Can you hear? Yeah. So
yeah. I think I know you.
good to know you. First, thanks for a really great presentation. You've consolidated an entire semester college course in international finance in less than an hour. So that was a great job. But I'd like to address mainly one thing, talking about the potential supply of new gold.
Yes.
And everybody was talking about the mining, the primary production of gold,
Yes.
which, as you said, could be very expensive to extract. But I think that is another factor here, and only time will tell how serious that factor is, and that is the secondary supply of gold, namely from jewelry,
Yes.
scrap gold. So as the world gets poorer, let's say in many countries, there's a potential supply coming out from all sorts of jewelry, and we've seen the parallel. I mean, at least I remember the parallel was during the first big silver bull market, where Bunker Hunt was buying all the visible gold. And I had a conversation at that time with one of his brokers, and he said, like, what's going on? What do you think? I said, you really got to take into consideration potential secondary supply. And now, as the price starts to rise, there's really no way of telling, how much new supply is going to come to the market. So that's something that, we need to really watch. I mean, this increase in gold has happened very, very quickly. So it's going to take a little time for us to really see whether the markets, to what extent, are going to really absorb that new supply. But as you said, there's so much bull case to be made. And I want to get to the second point, and that is that, you talked a lot about rationality in terms of, owning gold and not owning gold. And here, from an accounting viewpoint, there seems to be a contradiction. On the one hand, you've got countries that owe a tremendous amount of money. They're really tremendous debtors, and at the same time they're buying something in gold. So what's the point? You owe $10, and now you buy $1 worth of gold. Why bother buying the $1 worth of gold? Don't buy the $1 of gold. But essentially, and this is, I think, relates back to the original question of your topic, and that is the role of gold in an international monetary system. So the way I understand, and I think that implicitly, I think and please tell me if you see it differently, what's really happened is in a very rational way, but it's informal. Informally, they've decided, let's say the United States, look, some point comes where maybe the dollar be completely worthless. Somehow, as maybe just to take the scenario, and they say, look, they tell the Chinese, we're not going to pay interest, and they're going to go away the same way that, the South American countries went, Argentina, etc. So at that point, the money becomes worthless. Now, the United States still they have needs to buy things. If people are not going to accept the dollar, so they have the gold. So they can meet their requirements to make acquisitions, to make purchases, not by using their own currency, but by buying the gold. So this is the mindset of the central banks right now. They're saying, we don't know how far depreciated in the future our currencies are going to be. And if we'll need armaments, let's say, because we're getting to a much more increasing, belligerent, war type of civilization. And if we need to buy, planes and weapons, the way we're going to be able to buy them is only through gold. So basically what they're saying is we are hedging our own currency. We definitely have a need for gold for potentially to cover purchases that we need that we will not be able to do through our own currencies. And I think that this is an important way maybe to look at the role of gold in the international monetary system. It's not as formal as it was before, but there's an understanding that they have that need in order to protect themselves from their own depreciations that they're causing to their own currencies.
It's possible, and there's even a rumor that the U.S. would consider, they cannot do it at the moment, but they would consider paying off their debt with gold. Just that it's just not high enough, the price, right? Because they owe about $37 trillion of money, and the value of their gold is only $1 trillion. So it needs time, but maybe in 10 years, their gold price will be high enough to pay off the debt. Let me get on to some of the other ones. Maybe there are other questions. I see a few people raising their hands.
So I liked the question about whether gold could be made from some other element. I had a discussion with some colleagues at Stanford about this some time ago. Of course, alchemists have been trying to make gold through various chemical processes or even nuclear processes for a very long time from other elements. But I've been assured that it's not as simple as just reaching in and removing a proton out of mercury to go down to gold, which would be it sounds very tempting. It sounds very simple when you look at a periodic table, but I'm assured that to make a few ounces of gold, you need like hundreds of megawatt hours of power. You basically need a nuclear power plant to process just making a few ounces of gold. But anyway, I wanted to follow up on you also in response to that question. You started saying a little bit about Bitcoin and cryptocurrencies, and wondering if you could elaborate a little bit more on whether you think there are any central banks out there actually buying cryptocurrencies, holding them as reserves. Do you think there's any future in that? What are your general thoughts about Bitcoin, particularly, and cryptocurrencies in general? Thanks.
Look, to the best of my knowledge, no central bank owns gold Bitcoin except for Salvador. I think Salvador has taken Bitcoins in, and I think they even try to impose Bitcoin as a official currency. But I'm not aware of anybody else doing it, and I understood that they did not do very well with trying to do it with imposing it as a currency to use. It would never be a currency that can be used because of the fluctuating price. It can only be a store of value, if anything, just like gold. I mean, it's very hard to conceive or very hard to believe that anybody would eventually change to a system where you have to pay with gold coins, and because the price fluctuates, that would work. We're talking mostly about stores of value, right? Of how to keep money. Instead of keeping it in bonds, you keep it in gold or Bitcoin, whatever. So no, central banks haven't done that yet. It would be interesting to see if they do it. It would be. I'm surprised actually that we haven't seen any of the major central banks even buying a little bit of it. But I cannot give you an opinion about Bitcoin. I don't. I don't know enough of it to be able to say whether that can take the place. But all I can say is because I'm involved in trading markets. I can only go with what's accepted right now in the central bank market. Gold is accepted as money in a way, but I don't have any indication that anything else will take that role for now. I can't give you any opinion about it.
Do you think that gold would ever be switched like with another alloy like platinum that is much more scarce and also has a usage in daily life?
That would be what? Mixed with something else?
Oh, no. I said, do you think that gold would ever be switched by platinum, for example, that it's more scarce?
You mean will it be? Will they change their gold holdings for something else, for platinum, for example?
Yes, thank you.
I don't think so. I don't think that the platinum market is large enough to be able to do that. I think that if they would want to, if central banks would want to buy platinum in the quantities that they have gold, the price would have to go up 100-fold or something. I don't know. There's just not enough platinum being produced. So remember that one of the things about gold is that there is a good quantity of gold that can be traded. There's a good market. There's good liquidity in that market, especially today at this price. Hundreds and hundreds of millions of dollars trade a day, and that's important because you need to have liquidity, and you need to have a good market for it, which means that when you want to sell or buy, you want to be able to sell or buy in a very tight quote, right? Very tight market, bid and ask. So I don't think anything else will take its place for a long time to come. Again, I'm not giving an opinion about Bitcoin, but there has to be a good market, and it has to be a large enough quantity traded every day.
So just one last thing though, then I want to introduce you to someone else. But also just speculation that's even worse than everybody's thinking about, because everybody is looking at all this national debt, and what's being ignored are the massive unfunded liabilities of these national pension systems, in the United States and Europe. I mean, this is a meaningful thing the other day where the German chancellor came out and said, look, we can't pay for this welfare state anymore. Josh was saying the other day, that when you look at the projections from the Congressional Budget Office, they're making an implicit assumption that what's going to happen with the unfunded liabilities of Social Security in the United States is they're just going to pay with general revenues. What does that mean? They're going to raise taxes? No, they're going to print money. So I think it is a very, very not pretty picture.
I agree.
Anyway, Debbie, where are you? I just want you to meet someone. Please come. So this is Debbie Napomovsky.
Hi.
She grew up in Chile, and she went to the Maimonides School in San Diego.
Hi.
How are you?
I'm fine. So I'm Debbie Napomovsky. I'm 21 years old, and I came to Israel 10 years ago, but I was in the Maimonides School until I was 10 years old. And I wasn't surprised that the same Friedberg of this institute is the same Friedberg of the school. It is the program is really special, and also my school, I have really good memories about it. And if you were my friend when I was in the high school or in the elementary school, I always say that my model school is the best school. I'm not saying it because now I feel it, and I just want to say to you thank you. And I have good friends from there, the team, the principal, and just say thank you.
Okay, thank you very much. Thank you. I'm not the same one. I'm just a ghost.
Okay.
Thank you.
Thank you so much. And we look forward to seeing you in person here very soon.
All right, Bob. Thank you. And regards to all the boys and girls there, and I hope you enjoyed the rest of the seminar.